All right, welcome out to Market Master for Stochastics. Corey Halliday here with you. As always, just a reminder to make sure you follow your trading plan. So as we look at the stochastic as compared to the RSI, so the RSI gives fewer signals, even though it's a 70-30 reading. It's the way it's built, you don't get as many signals above 70 or below 30. The stochastics gives a lot of them traditionally. So it's not hard at all for the stochastics to get up above 80 or below 20, or up above 80 or below 20. They'll happen with frequency. So by getting more signals, you probably need to add a lot of other filters if you're going to use the stochastics to say, okay, how do I filter out? I'm getting so many. How do I filter out what's good and what's bad? What do I really want to use? And this was developed by George Lane. It's kind of that traditional, is it overbought, oversold? And the indicator is comprised of two lines, %K and %D, and can signal kind of buy and sell. So notice the crossover system. Crossover to a buy, crossover to a sell, where the two lines cross each other. Now, when those buy or sell signals happen, within, if you get a buy signal in the oversold or you get a sell signal in the overbought, that's designed to be better and more accurate in terms of the signal. Here's the formula for it. It's basically taking this equation and taking it over a period of time and saying, okay, well, what do we have here in terms of an oscillator, something that's oscillating in price? And if we put these inputs together, how do we see signal changes? So I would compare this a little bit, I guess, to something like moving average crossovers, in that if you were to put two very short-term moving average crossovers, if you were to put a 2-period moving average with a 5-period moving average, what would you get? Well, first of all, you'd get a lot more signals, wouldn't you? You would have two period and 5-period moving averages. It wouldn't take much. You turn for a day or two and you're getting a crossover. So it just isn't going to take much. Now, if you take longer term moving averages, if you take that out to a 20-period crossing a 50-period, now you're not going to get nearly as many signals. And so this one is designed with the typical setting of 14, 3, and 3. It is designed to give more crossovers and more signals, using other factors to kind of filter those out. So again, any reading above 80 is said to be overbought. Any reading below 20 is said to be oversold. So overbought is kind of saying it's too high, and oversold is saying, well, we're too low in price. A cross above 80 is a signal that buying momentum is waning. A cross below 20 is a signal that selling momentum is waning. And when we say a cross, we mean the two indicator lines, they cross each other and start heading the other direction. So notice how the thick line crossed above the thinner line. This thick line crossed down below the thinner line. That's the crossover. And if you get those when they're up there at those overbought or oversold conditions, then it's kind of, hey, the momentum on the upside is no longer there. The momentum on the downside is no longer there. That's the idea. So default numbers again, 14, 3, and 3. I've seen all sorts of combinations that people will use in their stochastics. So you can play around with that and kind of find, okay, well, what's the number for me? Is there any niche here in terms of the sweet spot and so on? And there's always a balance when you go through timeliness and accuracy. If I were going to use the stochastics a lot, I kind of prefer the RSI indicator myself, just because it filters out a lot of the signals. But if you did want to use the stochastics, for me, I would probably widen out those numbers, make it more difficult for the crossovers to occur, and then see if that improves the accuracy of it all. I'm okay with patience. I'm okay with not having a ton of signals, but having the signals be more accurate. And most people tend to feel that way. That's why I said if you're going to use something that gives a lot of signals, you probably better have a lot of filters on that to say, well, what should I use and what should I not? So the stochastic shows the position of the most recent closing price relative to the high-low range. And that thereby it's kind of measuring the momentum of the stock against itself and saying how strong or how weak are we. A downward cross of the percent K line through the signal line indicates that the current closing price is closer to the lowest low than it has been in the previous 3 sessions. So because we're using a 14, 3, and 3, if you get the current closing price of the stock closer to the low than it has been in the prior 3 sessions, you're going to get that crossover. If we widen it out to a 5 period, then it would have to be lower closing price to the low than over the past 5 sessions. If we widen it out even further, again, it would widen that out. It would give fewer signals because it would take more of a turn, more of a change to get the signal. So some traders like this because it gives so many, it can give you a lot of action, right? So here's a sell signal. Here's a sell signal. Here's a sell signal. Here's a sell signal. You know, you're getting them over and over again. The first 2 were sell signals that happened up above 80. The other 2 were not, right? So this is, you know, sell signals. Here we have buy signals. See the buy, the percent K line crossing above the signal line. Here we have a buy. Here we have a couple of buys. Here we have a buy signal. Which ones crossed below, did the crossover, but were below 20? Well, only this one and this one, right? Those were the 2 that happened when they were below that 20 line. So that has a little added importance because it's happening where you're in that overbought or oversold condition and giving that crossover turn. The strongest symbols will almost never have a stochastics reading under 20 because it's so aggressive in terms of the buying. If a very strong symbol does get a pullback where you get below 20, could be a signal of a trend change. So this can reverse for, you know, downtrends. This is because it's an oscillator, it doesn't have to be used as much in a trending environment, but you always have to be a little bit careful and cautious in terms of which signals you're using on the stochastics. So when would the stochastics work the best? Well, here you're starting to get some crosses that occur around the 40 to 60 level. If they happen at the 40 to 60 level, then you're saying, okay, we're in that zone where, and actually it should say 60 to 80, I think. Let's correct that. When you're in that 60 to 80 level, 60 to 80 level is kind of that upper quadrant, right? So we have a healthier stock. And again, the stronger stocks will really probably not get all the way down there below 20. So they're probably not going to get that big drop, that big dip, that oversold condition. And if they do, that can be a little bit of a cautionary tale. Now, again, some traders say, well, how do we use this? It depends on your approach, right? If you got a buy signal that happened below 20, what's the added importance there? Well, it's quote unquote oversold and giving a buy signal. So somebody might look at that and say, well, that sounds to me like a better signal. I think that's a profit taker. That's kind of like, you know, if you're short and it gives a buy signal down there below 20, remember what we said about the RSI. If you've watched the RSI class, is the same concept. If you get a reading below 30, it doesn't mean that you should rush out there to buy because it's oversold. No. It's more like take profits. It's more like You know, don't play it counter trend necessarily, but it's kind of like, okay, maybe I don't want to keep shorting it. Same concept here. If you are short something, this could be a take profit signal on your shorts, or this could be a, hey, don't keep shorting it. It's already below 20 and it's giving a buy signal. I hope that makes sense. If you're buying in an uptrend, most of your signals should signal strength and health. So a reading here in that 60 to 80 range is where it's healthy, it's strong, it's relatively good. You know, nothing wrong with that. On the bear rallies, you'd be unhealthy. So you'd kind of be, if 50 is right in the middle, of course, we could say kind of 50 to 80 is your bull zone, 50 to 20 is your bear zone. Okay. So I might even, you know, I'm kind of changing this on the fly, but I'm going to call it 50 to 80 is kind of the bull zone, and 50 to 20 is the bear zone. So when you're getting signals in that area, that's the bear zone. And in this case, you're looking to short something. Well, if you got bearish crossovers that occur in this 50 to 20 zone, those could be the ones that are kind of, hey, these could be signals. They're working with the trend. Yeah, we're not getting crazy overbought and oversold, but again, we don't usually trigger into new trades because of overbought and oversold conditions, right? How might that be helpful? Well, if you start getting buy signals that are up above here, it might be more along the lines of, okay, at this point, you know, start to think about this in terms of it being stretched maybe. So if I'm bullish and if I start to see some sell signals up there above 80, maybe I take profits. I don't short necessarily, but maybe I take profits, or maybe I stop buying and start to, you know, look for something else to trade. So sustainability is kind of what we're talking about. Range bound stochastics works well on stocks that have clear defined ranges. And like I said, this is an oscillator. So whereas with the RSI, we really ignore the indicator in a sideways move, I think this is where the stochastics could shine, is in more of that choppy kind of back and forth. If you are playing just quick signals, you can only be in for a few days probably, but maybe that's the approach to it. I tend to not trade super short term. I don't take, you know, I'm not a day trader and things like that. So, you know, that's kind of not my approach, but that could be an approach to it. When stochastics fails, well, we don't use it so much, again, to kind of fall into that trap of, you know, this can't go any further because it's up here, or it's down there, it can't go any further. We just know that momentum's a very real thing. So I think people fall into that trap of thinking that they're going to look for the overbought and oversold readings, and that's how they're going to make money. And what you'll find is, just with a lot of charts, when you first move to an overbought condition, you often go sharply higher. Or when you first go to an oversold, you often go sharply lower initially. Yeah, maybe it fades off and you shouldn't keep doing it when it's been overbought or oversold for a handful of days. But initially it can often, you know, spike and surge and really see a move. So in terms of price action and momentum and so on, that's kind of the approach to it. So here we've talked about understanding how to input the stochastics in your chart, making sure the numbers you use, the inputs match your time frame, only a confirmation to what's happening in price action, and make sure you back test this. Let's go live and take a look at the stochastics on a chart. So I'm going to swap out stochastic for RSI, or pardon me, vice versa. Take out RSI and go to stochastics. Now here's something interesting. You've got the full, you've got the slow, and you've got the fast. If we go to full stochastic, see the default of 14, 3, and 3. Here you have the signals, and look at how many signals. I mean, just over and over and over again. Let's just go 2 months. We'll really shorten this up. in 2 months' time, you've had quite a few signals. I mean, here's an indication to sell that was up above 80. But notice you had a sell signal right back here above 80. So some might look at this and be like, wow, the stochastics is wonderful. Look at how good it is. I mean, it told us to sell right in here, and look at how it plummeted from that point on. Well, it also told you to sell right back here, and we went down for a day and then right back up. So you've got to be a little bit careful. You've got to, this is the problem, a lot of false signals. I mean, here it's buy, sell, buy, sell, buy. So what I've often found is the following. When you use indicators like this that start to give a lot of signals, what I like to look for are little indications that, and I don't mind seeing that a couple of prior signals have failed, but I see a little something of a shift and a change. For example, hypothetically, if I were going to buy energy and use, again, this is kind of a profit taker signal more than step out there and buy it and try to play it to go up. But when would I take profits on my short if I were bearish on this? Well, here it told me to take profits, because that's a buy signal below 20. And here it told me to take profits. But is one better than the other? Well, in hindsight, the second one worked, but the second one also had a bit of a kind of divergence here, meaning it happened at the same level, but the price action had fallen sharply lower. So a little bit of a divergence in that, when prices go to higher highs, the indicator should climb to higher highs. And when the prices go to lower lows, the indicator should go to lower lows. And that didn't happen. Here we had lower lows. So those were both lower lows in the indicator and the stock. Here we made a lower low in the stock, but not in the indicator. So there was a little added element there, a little bit of an additional signal. Okay, here you get a sell, it quickly turned back into a buy, and so we're currently on a buy signal. We're already getting up here above the 80 level, and the price action's not super strong. So that's why I say it can really move around and give a lot of signals without the indicator or without the price action doing a ton. If we were to change the parameters, we could come in here and tweak it, and we could make it more difficult for different indicators to occur, and if you do that, you'll just get fewer signals. So if I change that to 14, 5, and 3, now I come up and look at it. Well, now we've got less to work with, right? Not a ton less, but a little less to work with. You can still see the divergence here as the indicator did not go down with the price action going down further and so on. And we've stayed on a buy signal since here. We didn't get that little whipsaw sell signal. We're still on a buy signal. So that's just by changing it to a 14, 5, and 3 instead of a 14, 3, and 3. It just takes a little bit more time to get that change. If we change it to a slow or a fast, of course, it's going to do exactly what it said. A slow stochastic, well, it's going to slow everything down a little bit, and it's going to say, okay, don't give as many signals, don't move as rapidly, and so on. And if we speed it up to the fast stochastic, well, everything, look at how sped up it is. And here's the problem with it. I mean, buy, sell, buy, sell, buy, sell, buy, sell, buy, sell, buy, sell. So they're all over the place, right? The slow can speed it, can slow everything down. For me, I prefer slowing the process down. Go ahead and give me fewer signals. That's perfectly fine, but give me a little bit better signals. So again, I said it before, I tend to use the RSI indicator more than I use the stochastic, but I'm not suggesting that's right for everyone. We always say that we really want our traders to find the best approach for them and what works for their situation. So find your niche, find what works for you, play around with the stochastics, back test it, see if you can improve the results by adding other filters, and go from there. Hope you've enjoyed it. That's it for the stochastic indicator. Have a great rest of your day, and we'll see you next time. Goodbye, everyone.